So thank you all for coming. This panel is about building climate resilience, and I know it says new data sets and AI, but what I'm gonna have everybody do first is just quickly tell you who they are, what they do, and how much they actually use AI in their work, because I think that varies a lot. We'll just go this way, and then I have a kind of ridiculous way that I wanna get this conversation going. So Eric, you wanna tell me who you are?
Good morning, everyone. I'm Eric Roberts, Senior Manager of Climate Risk and Resilience at the Nature Conservancy. And to be honest, we don't use AI a ton in my work, mostly just to capture meeting notes.
Ken?
Ken Zockoll, Spatial Risk Systems. We are a data governance company, so we connect, standardize, and taxonomize dozens of geospatial data sets into a single knowledge graph structure, which I'm sure a lot of you know is the ultimate data state for anyone trying to play the AI game.
Good morning, everyone. Paula Grieco, Senior Vice President with Commonwealth. We are focused on building financial security and opportunity for people who are financially vulnerable. And we do that through research and innovation and partnerships. We have in our strategic pillars, one pillar is focused on financial AI specifically. So we think about a lot about how financial AI can be used, and particularly about how the needs and aspirations of people in the lower and moderate income range can, the opportunities for them with it.
And Helge.
My name is Helge Joergensen, one of the co-founders of Cyberlytics, CEO, and a geologist at the background. We work with flood predictions, basically predicting how the next flood will impact all the kind of the buildings, all the way down to the building levels in all of the US. We use machine learning a lot because we train our models on claims. We're also using AI or machine learning for also predicting where the water should flow, like where is the culverts and infrastructure, all of which is important for, say, where the water will flow. So we use it quite a lot. So when the data we build is used by the insurance companies to pay a better price and to do underwriting.
And the somewhat ridiculous exercise that I asked each of these very patient people to engage with comes from my background as a journalist. I covered the aftermath of Hurricane Katrina, I covered Hurricane Rita, I covered Hurricane Maria in Puerto Rico, and I have seen firsthand a lot of climate change-related destruction. And so I asked them to engage with the idea that a Category 5 hurricane is on its way to Boston. And that impacts the work of each of these people, theoretically, and it's our way into this story about what they do and how to mitigate climate risk. Can you get that news? What is the first thing that you would do to get a picture of the kind of risks that you all can model and quantify?
Sure. So if a Cat 5 hurricane, slams into Boston, I just want to preface that by saying one of the data sets that we have in our graph is the NOAA Severe Weather Event Database, which basically has events and losses back to 1950. And so if you look at the Boston metropolitan area, the average loss per capita from that database is about $163 per person. If you look at Houston, which has the same top physical risk as Boston, which is cyclonic storms, or nor'easters, or hurricanes and nor'easters, their loss is $11,000 per capita, right? So it's a much higher number. So the key point here is that in order to effectively measure and quantify climate resilience, you need to get at the most granular level possible and understand things from an asset level location perspective.
How do you do that?
We track assets for public and private companies all through Boston. So there's about, in the city of Boston, or metropolitan area, there's about 10,000 businesses or facilities subject to EPA oversight, so the water quality, air quality, resource recovery, or emissions. Of that number, about 1,700 are owned by public companies. And let's say the top 5 emitters are all power plants, biomass or natural gas powered, and the top toxic release, something that's harmful to the environment or to a person, is actually a fiber optic cable manufacturer whose parent organization is a public company based out of Switzerland. So understanding where the assets are and what their impacts are is a key piece of the puzzle, right? So if power plants go out, who's going to have power outages? Where is that going to happen, right? So it's important to understand where your assets are and what their vulnerabilities are from a physical risk and also transition risk perspective.
Helge, your company does both near-term and long-term flood risk, but I understand, at least from your modeling, you can say, okay, give us 5 hours, and we can tell you where the flooding will be. How does that work?
So it's actually 72 hours. So because we tap into the weather forecasts. So given that the bad weather or this hurricane is coming towards Boston, then we would know kind of what the weather will be. And since we have mapped out the response of the terrain, because it's the response of the terrain that determines if you're going to be flooded or not, it's not the weather is just bringing the consequence, right? So if you have a lot of paved area, for instance, then you're more likely to be flooded, right? But we take the weather and we transform it into actionable risk data. That means that asset owners can tag their own buildings, and as just was pointed out, the granularity is super important. So then we know all the way down to the details of 3 by 3 feet. So we covered all of the, like Boston with 3 by 3 feet resolution terrain models and land use covers. So then we can say that all of this weather or this rain, then these and these building will be flooded. So if you are an asset owner, we can tell you that in, let's say, 54 hours from now on, then your area will start to flood, and you will be flooded for 4 hours, for instance, before we can see the flood goes down again. So if you know all of this up front of the storm, 60 whatever hours before, then you can do a mitigating action, right? Then you can take values to higher ground. You can get critical staff into locations or send people home to home office that day. And you can basically save your values, right? So during Beryl in Houston last year, that hurricane had a kind of abrupt change in trajectory. So then it was picked up 28 hours up front. So then we do every hour we update the model. So they used that information throughout the getting ready to the storm. They got the right doctors in place at the hospital so that they can keep the business up and running before they need to shut down the facility. They know when the different roads will be closed and so on. So it's if you have those kind of data, then you can basically do a lot of business disruption and keep stuff up and running, even though you're going flood, because you know when and how it will hit you. You will know it will be 6 feet of water surrounding your entrance, for instance.
One of the things that we talked about a bit backstage was that the idea that this actually can be part of a trade now, part of maybe even fiduciary duty now for portfolio managers, for investors. And that feels like a very fundamental shift, thinking of climate responsibility. And Paula, I'm going to get to you in a second, but Ken, I want you to address this question, where climate risk is something that is taken on board when just assessing an asset. That feels new.
Yes. So, if you think about, a good example would be NVIDIA, right? It's the most highly valued, public company today, right? They don't actually manufacture, but they design chips. 80% of that real estate is in Santa Clara, California. One major earthquake, and there's a material impact on their valuation. Their biggest supplier is 100 miles across the Taiwan Straits from China. So understanding companies where their assets are located around the world, what the physical risks are, transition risks, is becoming a piece of the puzzle as we move forward. Portfolio managers, investors, anyone doing transaction due diligence is going to have to do some sort of geospatial sanity check as we move forward now. It's going to be not only a fiduciary responsibility, but it's pretty soon a regulatory one. And I think that's the direction we're headed in, and basically having a very accurate map at asset level of who owns what functions and risks is going to be the piece of the puzzle. And if you think about it, it's going to be it's a geospatial layer that's going to be basically part of a company fundamental data offering. It's really a reference data solution we're looking at here, being built as we speak, that can be bolted onto company fundamental data sets.
So Paula, this is where I want you to come in and talk about some of the survey work that Commonwealth did, because when we talk about, say, a potential hurricane hitting Boston, we know that extreme weather events tend to disproportionately affect low and moderate income people when we're talking about issues of insurance, underinsurance. But one of the things I was really struck by, you all surveyed those workers about what they wanted employers and financial institutions to do. And I thought this was really striking. I wonder if you could talk a little bit about that work.
Absolutely. So to begin with, the workers that will be most impacted by climate crisis are those financially vulnerable workers who we define as those earning from 25 to 80K. Climate hits, they can't get to work, they have reduced hours, their business closes, they won't be paid. So we understand the safety risk, and safety is first, but often the long-term financial instability that occurs after a crisis, those invisible impacts are sometimes missed. We surveyed 1,200 workers, all earning financially from 30 to 80K in various professions, mostly workers that need to be on site, no matter what the conditions. And what we found is, one, that many of them, over half, have either experienced the financial impact themselves of a major climate event, or know someone who has. There's also a lot of anxiety about that, meaning that 46% are concerned that they wouldn't be able to recover themselves if they were hit by a financial event. And then we also surveyed them about where they'd like to get help and support. Unsurprisingly, the workplace continues to increase as a place for support, and 80% of those surveyed felt like employers were the place that they really wanted help most, followed by government and then financial services. From our perspective, employers, this isn't just a do-good benefit, but it's to the benefit of the employer to offer services that support, benefits that support workers.
Can you illustrate, like, what would those be, and how does that become, I guess, sort of in the self-interest of a business?
Yeah. So examples might be emergency cash is one example of having an emergency cash fund for workers. Second is parametric insurance, which is something we're very interested in. So it's the idea of parametric insurance is probability based, based on, for a hurricane or based on wind speed. If you live in a certain area, there's a higher likelihood that you'll encounter an event like this, and when an event happens, the payout is automatic. So there isn't that lapse that can sometimes be incredibly detrimental and difficult for workers earning LMI. In the back, we were just talking about livelihood insurance, which is something we haven't investigated, but we're very, very interested in that opportunity. So those are ways that are pretty straightforward and pretty low cost that employers can have a significant impact.
All right, talking about insurance, Eric, this is my segue into you. So I know that the East Coast, and we're talking about the Boston area, is not your bailiwick, but let's take it as a hypothetical, and maybe you can segue to some of the work you all have been doing in Hawaii and in Mexico to talk about what you do with your sort of theoretical inbound storm and then move to natural asset insurance.
So my role is I figure out how do we use insurance as a tool to help communities respond to climate risk by managing their natural resources. And so what I would be doing as a storm is coming in, assuming that we had a natural asset insurance policy in place, would be watching the storm track, seeing is it going to enter our kind of defined geographical area, and what wind speeds are happening, or what wave heights. And those would be the variables of a parametric insurance that might trigger a payout. So we would be alerting our network of partners that would potentially use the payout to help repair the ecosystem after it's damaged, and alerting them to be ready to respond. So what do I mean by natural asset insurance? The idea is a parametric insurance product that when it pays out, the money can be used to assess damage, to begin to repair that damage, so that you can maintain the values that the ecosystem provides, whether it's flood risk reduction, livelihoods from some tourism and fisheries revenue or jobs, or even just cultural, significance. And all of this work is based on a model that we developed in Mexico and we have now active in Hawaii, where we've set up a network called the Hawaii Emergency Reef Restoration Network. It's a group of 13 partners from across the state on each of the main Hawaiian islands, plus the state government and some private sector partners. And they're all trained to be able to respond after a storm comes through and triggers an insurance payout to go assess the damage and develop repair plans. And the reason why that they're interested to do this is because the reefs in Hawaii are so critically vital to the economy. They provide $830,000 every single year or $836 million in flood risk reduction to the state of Hawaii. The reefs provide, I think, more than $1 billion every year in tourism revenue. The fisheries that are sustained by the reefs provide something like $14 million of revenue every year, and it's a critical source of sustenance. And so this group has come together to be able to use insurance and other financial tools as a way to maintain the reefs so that they continue providing those benefits.
Something you said to me that I think is really interesting and maybe speaks to why there is someone from the Nature Conservancy at a FinTech conference, is you said, our goal is to be able to monetize nature-based solutions to become an investable asset. And I think that in the world of finance might seem pretty eye-opening. I wonder if you could explain that a little bit and why, a bunch of people at a FinTech conference be like, what's the Nature Conservancy guy have to say?
Sure.
So, one of the ideas is to figure out how do we monetize the ecosystem services to make them investable? How do we make nature-based solutions investable? And one of the ways, particularly with these natural asset insurance policies, could be to create catastrophe bonds, where private investors would actually put up the money that would be used in a payout. So you would set up a special purpose vehicle. The sponsor, like TNC or some other organization, would pay premiums into the special purpose vehicle. The investors would put their money up. If the insurance was triggered, then the money that the investors put in would be used to actually do the post-storm response. If there is no insurance triggered, then the investors get their investment back, plus the premiums, plus whatever interest had been earned as their investment was being held during that time. So it's a way to tap into the private sector market and provide investors a way to earn money outside of the traditional market system.
Doesn't doing that, and frankly doing what all of you do, depend on having reliable, accurate, transparent data sets?
100%. So we leverage open regulatory data sources. These are all fact-based data sources, which LLM models do not incorporate. LLM models basically are using unstructured data sources. So if you're dealing with facts, they're pulling something from a magazine article that's 3 layers removed. So, using regulatory and fact-based data sources that sit in databases is critical to really play this asset-level intelligence game that we're discussing here.
Are you worried at all about the data integrity of U.S. government data right now?
I mean, I'm worried about the fact that the current administration may restrict some of those sources as we move forward. The integrity of the data, that's a great question, but if the U.S. government or the EPA says X, am I going to say Y? So
I don't know. I mean, that's kind of a big question.
Yeah. So we're basing it on open regulatory data sources. If there's another source out there, we would use it, but we haven't run across it. And so the other thing that's worth mentioning here that we're talking about is that, as we try to get down to this granular asset level, right? Most corporate reporting is self-disclosure happens at a company level, not at an asset level. So it's really hard to play the climate resilience game to measure and quantify things using sustainability reports published by public companies, and the whole specter of greenwashing comes into play as well.
How do you, Helge, I want to talk to you. You work, your company's in Norway, but also here. How do you find that across international domains? Like, do you feel that you can get the data that you need in order to do the kind of machine learning that you all do?
It's a good question. We work also in Australia and on many different locations. So the complexity of getting the data, the starting point data we need is, of course, can be a challenge. And I think when it comes to reliable data sources like both FEMA and NOAA is for us here in the US, it is, of course, we pay attention to it now as we use gauges and we use the weather and so on. So it's, of course, something we need to pay attention on. But luckily, there are other sources you also can use. But when it comes to machine learning models and how you do it, right, you need to be very certain that you have the data in which is of high quality. If you train a model on something which is of bad quality data, then the model will go all over the place, so you will not do it correctly, right? And one example of that is that we use claims that we get from insurance companies to train our model, because we run more than 600 physical parameters from geology, hydrology, geomorphology, and so on for each individual tile, and that we connect to the building. And then we use the machine learning models to learn from that data set. And if, like we have seen in some of the claims we received, which is supposed to be a flood claim, but it was actually a pipe burst or a washing machine that went bad, then of course if we say to the machine learning model, hey, this building had a claim, but it was a washing machine, then it got all over the place, right? So the quality of data when you do machine learning model is super, super important. So yeah.
It seems to me, I mean, one of the things that I'm curious about, we were talking about this a bit backstage, is where you are willing to use a model, use, whether it's generative AI or machine learning on a claim data set, and where you're not. And I think we all are in this sort of in-between phase of trying to figure out when it feels good enough, ready enough. I mean, can I see you nodding?
Yeah, look, at the end of the day, we talked about at the top, right? If you're going to play the AI game, your data has to be fit for purpose. They talked about it here yesterday about agentic AI. Data governance is really key. Getting your data in a state that you can leverage it from an AI perspective is critical, right? And that's why we're playing the knowledge graph game. We're connecting a lot of things. And all those new data connections illuminate new insights that were not possible before, because they're all living in their own little separate data schemas. So, if you think about it, AI is, we're in the middle of this big data connectivity arms race. Whoever connects the most data and exploits that connectivity wins. A good example is Palantir, right? You're reading about Palantir. They're basically, first and foremost, a data integration company, right? They integrate data first before they can drive insight from their software tools or visualization tools. So basically, at their heart, they're in the knowledge graph construction business. So once again, data governance is critical to drive AI.
Paula, I wonder how, when you think about the communities that you're working with, we have seen traditional biases be replicated in machine models, machine learning models. Does that become a concern when you are thinking about incorporating AI, training it on big data sets, say, of people's income data or census tract data or, population level data?
Yeah, it's a good and an important question. We do see generally that people that are Black and Latin, as well as women-led households, are disproportionately impacted by climate. We generally, around AI, are seeing quite a bit of hesitancy or reluctance in the workplace to really implement. So that's always a concern. As we say, it's the data dummy. It's really always about the quality of the data and ensuring that's intact. I I'm not sure that, there are large data sets that are being used today for different reasons in a more lower tech way that have biases built into them. But in the end, we believe there's real promise in AI to really be able to, especially in the workplace or financial institutions, as we see decreases in funding from organizations like FEMA, are going to have to play a more central role of, are we in touch with our employees? Are they okay? Are you healthy? Are you safe? How can we support? And that is such a logical place to integrate AI into the solutions.
I would just further add, a good use case for us is that we work with a company called INRIX. They are a car and freight telematics provider. And so they basically have real-time trip data. So we're connecting their data to our asset-level knowledge graph. From that, we can imply, facility-level supply chain relationships that were previously unattainable. Right. So another good example would be, we track all the Amazon warehouses in the United States. So we can track truck traffic coming in and out of those facilities on a daily basis, and from that you can infer or drive economic signals, right? From macro and microeconomic perspective. So the more data you connect, the more insight you can drive, to not only for risk, but for alpha generation as well.
One of the things that I would like each of you to talk about, when we were all emailing about kind of what climate resilience means, and whether that means having a resilient supply chain, or whether that means, Ken, you were talking about an alpha play, if you're saying, well, these assets are like the least affected. What do you want, and Eric, I'll start with you, people to come away from when they think about, this is either how I make my organization more resilient, or how I think about resilience as an investment idea, a financial idea, an idea that's not doing good, but actually doing well?
Sure. So I think for us, resilience really means that people and the ecosystems they rely on are thriving in spite of the changes that are happening due to climate change. And so they better understand the risks that are facing them and the resources that they rely on, and they're better able to manage them, potentially using insurance. Part of this is also predicated that they understand the value that the resources are providing to them.
Do you think that has become widespread yet, or do you think that's still something where you're struggling to tell that story?
I think there's growing recognition about the connection between nature and the ecosystem benefits that it provides to the broader economy, but it's still not being tracked on the balance sheets. And so that will be, I think, a really key piece in the future to actually have government agencies understanding how much value are these ecosystems providing in terms of avoided losses every year. And if we lose them, how do we manage that risk?
And do you think you can do that in this policy environment?
That's a great question. I think it may be challenging in the current policy environment. I do work outside of the U.S. as well, and so in different places I think are much more receptive to the idea than others.
Ken, how do you see building resilience? I have a feeling that your answer is going to begin with, you got to be able to measure it.
Yeah, as I talked about, if you can't measure and quantify it, it's difficult to fix it or address it, right? So, let's look at the LA wildfires, right? If you looked at the weather event history, there were no wildfires in Los Angeles County for 30 years. So it was basically out of sight, out of mind. There's nothing that was taking place from a proactive risk mitigation perspective that was taking place. And then, the wildfire shows up one day, and obviously you got billions of dollars in damages. So I think what we see is, from a climate resilience perspective, most of the work that's done is reactive and not proactive. So trying to understand what happened here in the past, even though it hasn't happened in 30 years, still you should not be ignoring it. And I think that's a big piece of the puzzle. I think we see it again and again and again in these disasters here in the U.S. and around the world.
How do you translate that into an investment?
Well, I think if you're a portfolio manager who's managing a portfolio, you probably want to look in what's the tornado risk in my portfolio. So there could be 20 companies in your portfolio. There's 3,300 asset locations around the world. You know where the tornado risks are from a top physical risk perspective, and you can quantify that. And so understanding that from an asset level with a top physical risk are is a big piece of the puzzle now. Where's the tornado risk? Where's the coastal flooding risk in my portfolio? That's all achievable today if you basically organize your data, make it fit for purpose, and that's where we're focusing our attention.
You know, you mentioned the LA fires. Paula, I feel like that is actually a good segue to your work. If you look at, say, Altadena, right, that is a rare community where you had a tremendous amount of intergenerational Black homeownership that was disproportionately affected by the LA fires. How do you find the next Altadena and make the case that this is a proactive economic move to get people insured and make sure that companies are thinking about, you know, employees and their coverage and what they need in a disaster?
Yeah, what's a base stat that is known and used is that financial stress results in $250 billion a year in lost productivity for corporations. So it is a measurable and important thing for corporations to be thinking about, not just because they value their employees as humans, but because it's good for business.
Because they're going to lose money.
Yeah, exactly. So that to me is at a baseline. And we do see that there's an opportunity for employers to think proactively around safety, as I mentioned earlier, you know, being able to be in touch, and AI is a perfect solution for that. Are you safe? Or can we help, and can we support you in any way? And also, but proactively, to be thinking about implementations like parametric insurance, understanding proactively what the risks are for the different populations of workers that you have, thinking about what if workers can't get to work. Is there an opportunity, you know, to rethink how employees are compensated if they're unable to get to work? And then for real disaster thinking, which many firms have, you know, look at most of the major, think of Walmart or Target, and most of the major corporations have started to think about some level of emergency cash distributions generally, and there's really, climate specific would be in that realm, and parametric insurance we already mentioned.
Helge, I know your expertise is in floods, but when you think about kind of long-term resilience, that is the other side of your business, the short-term and the long-term. How do you talk to clients, but also think about kind of building long-term climate resilience, and what should people walk away from this thinking about to have both, you know, whether you're a portfolio manager, whether you own a company, think about, is my business, is my life built in a long-term resilient way?
Yeah, I think for us, climate resilience is about providing detailed enough and accurate enough data sets so we can understand if you're prone to flooding or not, right? Because what we can see now is that our flood maps are being outpaced by the climate change, right? What is considered a 100-year flood now might not be a 100-year at all. And even though you are outside of a FEMA 500-year event, you can still be flooded, right? So one example we did recently, we looked at a portfolio of more than 5,000 locations across the US, and I asked them to see what was the proximity to the FEMA maps. And there were like just below 10% of them that were kind of close or within those areas. But when we looked at the different types of floods, which we see today, like urban flooding and you say storm surge and fluvial flood, we combine all of this, was actually 70% of those 5,000 that were prone for flooding could have some kind of flooding.
Wow.
So climate resilience is then to give that information so that you at least know that you are prone for flooding. And then if you're an insurance company, you can incentivize them to do something to reduce the flooding, probability to be flooding, but you need to know about it, right? So I think it's really important to have not rely too much on the history if you're going to get the future correct, right? Because it's changed. And I think, yeah, a Hurricane 5 here to Boston, that will be a surprising one, but it still can be like a heavy flash flood we can occur, right? And then you need to know which one are prone flooding, because then you can build resilience to avoid it in the future, right? And I think that goes both to the homeowners itself, but also to the governors, right? In many cases, or in some cases, it can be that it's the governmental kind of property, like a culvert or something, which is causing 10 houses downstream to be flooded, right? But the homeowners can't go up and dig a bigger hole. That needs to be the government or road authority that do, right? So it is about providing high quality data, which also is updated. Because we pay a lot of attention to the climate change and the weather, and there can be more rain in this area and so on. But if you don't understand the changes, what's happening on the ground, the cities are growing super fast. So the land use cover changes, the infrastructure changes, we have a new neighborhood coming up here. All of this will impact where the water will flow. So if you just kind of do the climate change and the scenarios, well, you will be surprised anyway, because the city and the water line running this direction instead of this direction. So you need to do both. That's the, yeah.
Well, this is sort of leading me to my last big point that I want to hit on. The federal government is increasingly getting out of the disaster business, right? We don't exactly know what the future of FEMA is going to be, but we do know that that probably means more will be borne by either the private sector or states, municipalities. And I'm curious where you all see opportunity there, how that change might affect, everybody sitting in this room, but also communities going forward in the next 5 years.
Yeah, so in the municipal finance space, it's becoming very important, because after most natural disasters, FEMA, federal or state aid, comes in and bails these communities out, right? So these cities and towns, what we call obligors, are relying on that external third-party cash to kind of basically bail them out. If that's not the case anymore, there's going to be a lot of bankruptcies, and municipal bond valuations are going to go down significantly. So this is an important consideration, understanding whether the government can support material disasters and whether that external funding is going to show up. If it doesn't, a lot of communities are going to be have a lot of trouble with their balance sheet.
Yeah, Paula, I can see you nodding.
Yeah, we have historically, we are, although our focus is financially insecure people, we use partnerships as the core of our business model. So we have seen tremendous success early on when there is a problem or a challenge identified and perhaps the private sector isn't quite ready or doesn't have the focus or the resources to invest. A partnership with nonprofits, NGOs, a private sector employer or financial institution or a fintech in philanthropic dollars. And so what we have seen there early on is that we can create the solutions together and then momentum builds. And that applies here around climate, just as we've seen it in emergency savings or capital market investing in other areas.
Eric, do you think the model that you spoke about, you say you have a group of hotels in Mexico that is doing natural asset insurance on a reef because it's valuable to them. If the federal government is pulling back from, being in the disaster business, does that provide more opportunity for that kind of partnership among private actors?
It's possible. In the United States, we haven't relied on FEMA for any of the work to date. But I do wonder if, with FEMA pulling back, will more states band together and create an opportunity to pool risk and, maybe open opportunities for the insurance industry in ways that they haven't operated in the past. But yeah, I think, with FEMA pulling back for us, it hasn't really affected our work to date.
Helge, I'll let you have the last word. I'm just curious, particularly with your insurance clients, is that a concern for them?
Yes, of course, because FEMA is a good source for data and good source for kind of understanding where you are. But I think also when if they change in how often they update their risk maps. There will also be gap that will be filled in with new innovation, right? If you're forced to do innovation, then you will also do more innovation. So might also be an opportunity for new companies coming in and help out, so yeah.
I think we're about to get the wrap up, but I wanted to thank all of you for your insights, for talking with me, and all of you for coming. I really appreciate it. Thank you so much.